Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money moves that shape our world. And today we're diving into Baker Hughes' latest financial report. Get ready because the numbers are telling a story, and it looks like this energy giant is navigating some interesting cross currents. Before we dive in, if you love getting the real story behind these corporate filings, make sure you are subscribed. And if you want to chat about this stuff in real time, join our Discord community. The link is in the description below. Let's jump straight into the heart of the matter, the company's financial performance. For the 3 months ending the 30th of September 2025, Baker Hughes brought in a cool $7 billion in revenue. That is a tiny bump up, about 1% from the same time last year. Now, look closer and you see a mixed bag. Their Industrial and Energy Technology Division, or IET as they call it, saw a nice 15% jump, adding about $400 million. But their oilfield services and equipment segment, offices, took a hit, dropping about $300 million or 8%. When all was said and done, their net income attributable to Baker Hughes Company for that quarter was $609 million. That is a noticeable drop, about 20% from $766 million in the third quarter of 2024. So while they're bringing in similar overall revenue, their profit is down. Why? Well, a few things. They saw lower earnings from certain investments when compared to last year, and some of their sales volumes and production efficiency took a dip. Plus, there were some extra costs from ongoing deals. Now, let's peek at their balance sheet as of the 30th of September 2025. Total assets are around $39.2 billion. That is up a bit from the end of 2024. On the liability side, they have about $23.3 billion in total liabilities and $18.3 billion in total equity. It is a massive company. And these numbers represent a huge financial engine at work. Looking at their equity, a big chunk of it is listed as capital in excess of par value, which is over $24 billion. This is basically the extra money shareholders paid for stock above its face value. On the flip side, they have retained loss of about $4.1 billion. This means that over the company's history, accumulated losses have outweighed accumulated profits. It is not uncommon for large growing companies, but it is definitely something to keep an eye on. Now, let's talk about goodwill. Baker Hughes has a whopping $6 billion in goodwill on its books. Mostly in the industrial and energy technology segment, goodwill on a balance sheet typically represents the intangible value of a company that has bought another company. It is the premium paid over the fair value of the acquired company's identifiable assets and liabilities. For example, they added $228 million in goodwill in the third quarter from buying Continental Disc Corporation. This shows they are actively acquiring companies to grow their business. Alongside goodwill, they have over $4 billion in other intangible assets. These could be things like patents, customer lists, or brand names. They are steadily amortizing these over time, meaning their value gets reduced each year. Let's look at the revenue breakdown for the 9 months ending the 30th of September, 2025. Total revenue came in at $20.3 billion. The oilfield services and equipment, or office segment, which is their traditional bread and butter, saw its revenue fall by about $1 billion to $10.7 billion. This decline is largely due to lower activity in the oil fields, meaning not as many rigs running and less demand for their services. But here is where it gets interesting. Their Industrial and Energy Technology segment, IET, is booming. Revenue for the 9 months jumped almost 10% to $9.6 billion. A big part of this growth comes from gas technology equipment, which saw a massive increase of over $700 million. This highlights a strategic shift, or at least an expansion towards what they call new energy solutions, especially in the natural gas and LNG space. Now, for the profitability metric that Baker Hughes really watches, segment EBITDA, for the 9 months ending the 30th of September 2025, their total segment EBITDA was $3.7 billion. OFS contributed $1.97 billion, but that is down from last year. IET, however, is the star performer, with segment EBITDA soaring to $1.72 billion, a healthy 22% increase. This shows that while their traditional oilfield business is facing headwinds, their newer energy technology ventures are not only growing but becoming increasingly profitable. The story here is a company that is facing headwinds in its core oilfield business, likely due to global market conditions and a push toward cleaner energy. However, they are making significant strides in their industrial and energy technology division, particularly in areas like natural gas and LNG, which are seen as crucial transition fuels. This diversification seems to be buffering the impact of the downturn in oil and gas exploration. The company's management clearly states the market is tricky. They mention ongoing geopolitical tensions and uncertainty around international trade policy affecting oil markets. They expect oil prices to stay volatile, but they're optimistic about natural gas, seeing strong demand growth, especially for liquefied natural gas, or LNG. This is a crucial strategic point for them, focusing on a more stable and growing part of the energy landscape. Their outlook for the oilfield services and equipment segment is cautious, expecting soft operator activity through the rest of 2025. This confirms the challenges we saw in their recent results. On the flip side, their outlook for industrial and energy technology is strong, with continued growth expected in areas like LNG infrastructure and a growing focus on data centers, which require a lot of energy. They also see opportunities in new energy solutions like hydrogen and carbon capture. Now, let's talk about that drop in net income. The report mentions a decline in the market-to-market adjustment of certain equity securities, which means their investments in other companies lost value. They also saw lower sales volume in some areas and higher costs. But importantly, they pointed to structural cost, saving measures and price increases, helping to offset some of these negatives. Baker Hughes is also strategically trimming its portfolio. They've classified certain businesses as held for sale. This means they are actively planning to sell them off. As of the 30th of September 2025, the total assets of these businesses being sold were over $1.1 billion. This includes their surface pressure control business and their precision sensors and instrumentation business. This is a clear sign they are focusing their resources on their most promising segments. And speaking of big moves, they've announced a massive deal to acquire Chart Industries for $13.6 billion. This is a huge bet on the future of natural gas and LNG. They've already got Chart's shareholders on board, which is a major step. This acquisition is expected to close in mid-26, and it is clear they see this as a key growth driver. They've even set up significant bridge financing to make it happen. So, what is the verdict on Baker Hughes' latest report? They are a company in transition. The old guard oilfield services is facing tough times with lower oil prices and less drilling, but the future, in their view, lies in diversified energy technologies, especially natural gas infrastructure. Their IET segment is showing impressive growth and profitability. The big question is whether they can successfully integrate the massive Chart Industries acquisition, and if the energy transition plays out as favorably as they project. They are managing their finances prudently with significant cash on hand and access to credit. But the debt load associated with the Chart acquisition warrants close observation. They're making smart moves to shed less profitable assets and double down on areas with higher growth potential. It is a complex strategy in a dynamic global energy market. Alright, that is our breakdown of Baker Hughes' latest filing. What do you think about their strategy? Are they making the right bet on natural gas and technology? Let us know in the comments below. If this deep dive was helpful, please hit that like button and subscribe for more corporate analysis. And as always, join the conversation on our Discord channel, linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.